Okay, back again for assessing options for drought response. Number 6, assessing forced sales with cow trade and bullocks. So, this is number 6, assessing forced sales from within cow, heifer and steer groups. And the example we're going to particularly look at here is selling extra steers and freeing up space for the PTIC cows. That's the choice we're going to consider. So, been on a fairly long journey. What have we done so far? We've counted and assessed, we've completed the analysis, situation analysis, looked at mortality risk, a really critical aspect of this decision-making process. We've considered early weaning as an important step. We've assessed whether it was better to sell, feed or adjust PTIC cow. We went on and then we assessed whether to adjust sales steers or sell early. Now, this is becoming quite complex now because most of those previous decisions have been fairly straightforward. Now we're getting into the difficult decision of, in a forced sales situation, who's got to go first. The sales are forced. So this is complex. So selling down the numbers of each cattle that remain on our example property, either the cows, the heifers or the steers. Now this is the younger age group of steers, because the older age group of steers have already gone to the stylo. Selling down each of those class of cattle, or numbers out of those classes of cattle, will have a significant impact on future earning capacity of the property. So when we're looking at these decisions, these choices, it's critical that the correct framework is applied so that the comparison is valid. Now, okay, in our Breakout Dynamo suite of programs, we've got 2 programs, cow trade and bullocks, and they're a good way of considering these choices. They are part of Breakout Dynamo. The cow trade program, it's about cows, obviously, as the name suggests, is used to calculate the prospective or the future profitability of breeder groups. So it's a program that looks at breeder groups, and those breeder groups will be, some of them will produce or already have calves. So that's, the program is designed specifically to deal with that group. The bullocks program is designed to look at dry cattle. Its name might be bullocks, but it deals with dry cattle. So it's used to calculate the future profitability of groups of steers and empty cows or heifers. They can assist in these decisions that we're looking at now where sales are forced by drought. So they're normally used to look at the future profitability, but we can turn them around and use them in this assessment process. So the critical indicators that we're going to look at in this analysis, you know, when you're looking at buying cattle, so the opposite to what we're doing now, you're looking at buying cattle to fatten or grow out. It's logical that the most profitable option, the one that provides the greatest future benefits, is the one to choose. So the best fattening or growing opportunity is nearly always the highest predicted gross margin per AE. So when you're looking at choices between different classes of cattle to buy them fattening or growing, it's nearly always the highest gross margin per AE after interest is going to be the best one. If finance is tight, if you haven't got enough capital to buy sufficient cattle, livestock, to stock the available pasture, then the highest gross margin is expressed as a percent of herd and expenses capital is a more satisfactory criterion. So it's the way this is expressed. The results there give you a good indicator of what's the best choice when you don't have enough capital to completely stock the paddock. Now, the other side of the coin, if selling stock to reduce grazing pressure or relieve financial pressure, then the object should be to achieve the least damage to future income. That is, if the issue is grazing pressure, so we've got too many cattle, we need to reduce, it is best to sell those groups first with the lowest gross margin per AE after interest. Is now the lowest compared to the highest. So if we've got to reduce grazing pressure, Sell those groups with the lowest gross margin per AE after interest. And we'll talk about why that's important. If the issue is financial, and that means you need to generate cash, it is best to sell those groups with the lowest percent return on livestock expenses capital. So it's just the opposite to getting the best outcome. If you're in a reduced grazing pressure situation, these are the critical indicators. Now, destocking versus drought feeding breeders. We've had a bit of a look at this before, but we're going to look at it from a slightly different angle now, in that we are comparing destocking selling breeders to selling other classes of cattle, in this case selling steers. So the choices for breeders are assessed using the cow trade program. We said that the calculation is based on a decision today to sell or not to sell. So I can sell them now or I don't sell them, with the not sell option giving rise to a sale or a valuation back into the herd. So if we keep the cattle, we've got to have this idea that we're going to have to look at the inventory valuation over time. So when they come back into the herd, we value them back into the herd to complete this calculation at some point in the future. The profit or gross margin calculation, which in this case is done the same way, shows what the contribution to net income would be if the group were kept, sold or valued back into the herd as against being sold now. So you can keep them and sell them later, or you can keep them and value them back into the herd and assess the value of that strategy by doing that, by looking at the inventory. Now, part of this story when we're comparing selling different classes of cattle is getting the right allocation on the amount and quality of feed available. So all this is based on there's amount of feed of a certain quality available in a paddock or across a couple of paddocks. So different classes of cattle will consume proportionally more or less of that forage. So if there's a certain area of feed available, you'll say, oh, well, it could put 10 cows in there, but you could put a different number of steers or heifers for the same period of time to do a certain job on them. So we could work out how many of each class would run in the paddock. So you could sit down with the property owner and say, in this paddock, how many cows and calves can you run until this time? How many steers could you run if the cows and calves weren't in there? On the basis that they would be equivalent numbers applying the same level of grazing pressure. Now, we can't always do that with the property owner, so we take this sort of other method where we usually convert each of those classes of cattle that are available to go into that paddock to a standard unit to allow comparison. So it's all about the need to compare them using the same level of grazing pressure. If you run more cattle and abuse the grazing pressure rule, you will upset the economics. So it's got to be this standard standard grazing pressure, standard unit of comparison. So the difference in feed consumption between groups is covered. The difference in feed consumption between the groups is covered by calculating what we call an adult equivalent or an AE ratings for each group based on weight and time. For all breed cow and dynamic software, it's fairly standard. An adult equivalent is a non-pregnant, non-lactating beast with an average weight of 1,000 pounds. The international standard, 455 kilos, carried for 12 months. So that's our standard unit for comparison. Animals of average weight over the 12 months of more or less than our standard weight are rated in proportion to their average body weight. Now, there's a lot of different ways of calculating AE, some based on metabolic weight, some based on other calculation methods. We simplify it and say, okay, this is our standard animal. If they are gaining more weight or younger or older, everything's in proportion to the average body weight of that alternative class of cattle over the period. In the next example, the cow trade program is used to assess this decision to sell or feed the PDIC cows. And we got to use cow trade because we want to compare that result to other classes of livestock. Our previous spreadsheet, which just compared costs, isn't suitable for this role. So selling some of the other classes of livestock left on the property may provide a better outcome than either selling or retaining the PDIC cows. That's why we're following this process. We assess selling versus drought feeding in presentation 4. This is different. As the cows were repurchased later, and we were all about maintaining the numbers on the cattle property over time. We weren't worried about the choices. This time, we're going to sell these cattle, we're going to assess the best ones to sell to reduce our grazing pressure, and then when the drought breaks, we're going to worry about what we do then. So it's a short-term analysis. So we compare selling PDIC cows to selling other classes of livestock. And the selling the steers, so in this example, we sell the steers and we free up some country that they would run on. So this is not the older steers, this is the second line of steers, and we're going to free up some of their country, and the cows are going to run on that, and in doing that we reduce the feeding cost of these PDIC cows down to $150 per head. Remember, it was quite expensive in the previous example. Now, if sufficient steers were sold to reduce the feeding cost to $150 per PDIC breeder, would it be better to keep the breeders and sell the steers? The saving is a reduction in cow feeding costs for 100 days. And of course, we're going to look at this in the spreadsheet. We've got two spreadsheets this time. The first spreadsheet looks at calculating the feeding cost of feeding these cows for 12 weeks, which is the spreadsheet we used previously. We only use it for the feeding costs. The second spreadsheet is the cow trade spreadsheet, where we look at calculating the value of holding these cows and feeding them. So let's open up the first spreadsheet. It's the same as the one we used in previous presentations. It's our calculator for comparing drought feeding costs. This time, we only want to use just the little cost part of it. And in that cost part of it, we said we're going to feed these cattle for 82 days because we've got rid of the steers, we've got extra grass. It's going to cost $320 a tonne to feed them. About the same consumption, same sort of feeding out cost for a shorter period, and we worked out it's $150.42. So that's all we use that spreadsheet for, just to work out the $150.42 per head for those feeding costs. We close that, and we open up the cow trade spreadsheet. Now, the cow trade spreadsheet, there's a user manual that's downloadable, it's available, been around for a long time. It's a summarised spreadsheet that just looks at this comparison of holding or trading breeders. So over here we've got some summaries where we can do some summaries of our runs, our different analyses. We've got to calculate the value of the owned stock on farm. We've seen that before. Calculate the cost of landed, the landed cost of purchase stock. So if we're going to buy cows and calves, we can value them there. And down here, calculate the net selling price for breeders and their progeny at the end of either the trading program or when they revalue them back onto the herd. So we can see here, it's a description of the group. We've got dates. So the starting date is the 1st of May when we're going to make a decision about what we do with these cows. The calving date, if we hold them, is about the 15th of November. The sale date for the adults is the 30th of April 2020. So it's this 12-month period where we're thinking about if we hold them or sell them, how do we value them in? How do we value the cost of holding them? How do we value the cost of buying them back? So you can see over here these summary columns are very similar to the analysis that we did previously on the cost of holding the cows. So we can do that same analysis here. That's just the similar sort of analysis done in cow trade. But in this case, we're interested in what is the gross margin per adult equivalent after interest of holding these cows. So we weigh them in at the start and the end the same weight. We say, okay, during that period, they're going to have we're going to be able to get a weaner off at about 170 kilos. Because we want to count the grazing pressure applied by the calf post 5 months, we identify the weight of the progeny at 5 months. So up until 5 months old, we have a rating on the lactation stress of the cow, the pregnancy, extra consumption of food, and then once the calf is 5 months old, we sort of add a little bit into the calculation for that as well. So that's how we accommodate that. We value these cows into the paddock. That's the same calculation as we did before, where we had to take them to the sale yards and reduce our selling costs, and we came back with 791.33. And then at the end of the period, we value the cow and the value the calf unit as what they will be worth in 30th April 2020 to either purchase back or sell, or what they're going to be worth to us in the paddock, and we put those in there. We've got an opportunity cost again on the holding the capital and not getting rid of these cows. We expect our weaning rate to be 90%. We expect, because it's a drought year where we've got to feed these cattle, we could have a death rate of 5%. Now, on the weaners, we could lose 2% out of our conception rate. Husbandry cost, $150 a head. That's our cost of feeding. We calculated in the other spreadsheet. Cost on the progeny, probably $5 to get the calves weaned. Now down here, we calculate the period of rating for the breeders. Now the progeny to 5 months is there, and then post 5 months we rate them for grazing pressure. So the adult equivalent rating per breeder, the progeny to 5 months, which is based on a value put in the spreadsheet over here, was based on some research done by Stu McLennan some years ago about the metabolizable energy and the rating of the calf and how many days and what size it was. So there's a fair bit of thought gone into rating the grazing pressure applied by the calf. And so therefore, when you add up the cow and the calf for that period that we hold them, it's about 1.32 adult equivalents. So that allows us to calculate a gross margin. We take into account our opportunity cost of interest on progeny and the breeders, husbandry costs, capital base that we've got tied up in these cows. So gross margin per unit, gross margin per AE after interest, and it says there this is the one comparable to Breed Cow Plus and Bullock. So that's the number. Now, if we're trying to free up capital and sell down cattle, there's our other number, return on livestock and expenses capital. So the two that are important to us, and down here we've got some sensitivity tables, gross margin per AE after interest, and it varies with increment in the breeder sale value or increment in the progeny sale value, and you can look there at different sale prices, progeny sale price, breeder sale price, on the impact on that gross margin per AE after interest. So that's our little cow trade spreadsheet, and that allows us to do a gross margin analysis for the value of retaining and drought feeding pre-TIC cows. And when we put it through cow trade, if we sold the steers, freed up a bit of grass, reduced our feeding cost, our gross margin per AE per year after interest was 113.61. So that's effectively our benchmark or our yardstick for selling the steers and keeping the cows. That's one side of our choice. The other side of the decision is to assess the drought retention strategy of the steers. So what if we don't sell the steers and we keep them? And this choice is assessed in the Bullocks program. Selling the steers and freeing up some grass allowed the estimated cow feeding cost to be reduced. It gave us that gross margin of 113.61 per AE after interest. How much income have we foregone if we do that and sell the steers? So we've got this Bullocks program. This one's called, the example one is called Sell Steers Drought Response Analysis. Keep the PDIC cows. You can download it and look at it and play with it. If we load it up. Now, this one has got the original version of Bullocks in it on this Bullocks sheet. There's some notes to explain that, how that works, and there's a user manual on the website. But we've also got this version here, which we call the Dry Cattle Trading Calculator, Bullocks in brackets. Now that does exactly the same thing as the Bullocks spreadsheet, only it's a bit more laid out in a little bit more logical fashion, and we can thank young Michael Sullivan from Rocky for working out that layout, and I've combined it with the original layout and formulas devised by Bill Holmes and put them together, and it's probably a little bit easier to follow. So we will go through this example again. We've got some boxes over here for transport calculators in and out and things like that. And we've got some sensitivity boxes down there, but let's follow down this. So this is for drought retention of steers, and they're our yearling steers. We're just going to calculate it for one animal. We don't have to do the number. It's just because we're doing gross margin per AU after interest, we can do it on one head. The date in and the date out is exactly the same 12-month period as for our cows, so we're assessing them over the same period of time, which is important. Their live weight going into the paddock is 300 kilos. Now we've got to work out their value, so their likely weight loss to the point of sale is about 8%. We expect to get $2.30 for them in the yards. We pay some commission, transaction levy, yard fees. We've got a freight cost there for getting them to the yards. So our net value on property is $5.65 or $2.05, even though we got $2.30 for them at the yards. Our variable costs, if we hold them, we've got some health costs, some other costs associated there. Probably in that, I've added in the supplement costs as well. Sale weight and price. So if we keep them, we expect them to put on about 1/3 of a kilo a day. It's pretty good grass in that paddock. That gives us a 413 kilo steer in 12 months' time, which was our normal saleable steer. 380 at the yards. We expect to get $2.40 for him. The commission's got to come out, levy, yard fees, transport costs we calculated over here and put in. That gives us an $824 steer. We've got possibly some losses, could be quite high because it's a drought year, and we're only going to put a little bit of supplement and lick and stuff, health into them. So we only get 0.96 per animal sold because we lost 4% of our one animal. Now we've got some opportunity costs to account for, the interest cost that we could have saved or earned by selling the steers and putting the cash in the bank. There's a little bit, tiny little amount there on the variable costs that we incur. Now the adult equivalent calculation here is we take into account the live weight at the start and the live weight at the end and calculate our average live weight, and then we rate that to our standard reference weight, which gives us an adult equivalent of 0.78 for this steer for that period in that paddock. So down here we've got our gross margin calculations, and our gross margin before interest and our gross margin after interest. So over here we've got some sensitivity tables, and we've got our sale price being varied up or down by 10 cents a kilo to look at the impact on sale price, and our purchase price of the steers over here being varied up and down by 10 cents a kilo to give us a table there. So that's the spreadsheet. Let's think about the answers. The gross margin analysis for retaining PDIC cows versus retaining steers was the analysis we did. We came up with 113.61 for feeding the cows and selling the steers. If we hold the steers, 213.39 per AE, so that's a comparable to that. The steers produce almost double the gross margin. Hence, selling the steers and reducing the feeding cost of cows would reduce the profitability of the business in the short term. So on that basis, we probably think about the selling the cows. So the comparison indicates there is a difference between selling the steers and selling the cows. It's quite a difference in the impact on the profitability of the property over the next 12 months. Drought feeding costs would have to be significantly less than the 150 we predicted for this analysis to break even, and the steers are expected to generate more profit over the next 12 months. So the focus would return back to what are we going to do about these PDIC cows. It's probably not worth selling the steers and spreading them out. Now, okay, that's just a comparison of the PDIC cows and steers of an age group. You can do the same assessment for each class of livestock on the property to come up with, okay, these ones are going to do the least damage to our profit. Let's sell them. That's the analysis you can go through. We've just done one example. There's a number of other classes of cattle, cows, and heifers on the property. So you can fine-tune your strategy using these spreadsheets. We've also put on the project webpage other spreadsheets that you can assess the value of sending cattle off to feedlots or feeding an energy diet based on molasses too. So if you want to think about setting up an exercise where you keep the steers and feed them M4U and try and put weight on them that way and give the paddock to the cows, well, there's a spreadsheet there to look at that. Or if you want to think about sending the steers off to a feedlot or some other class of cattle off to a feedlot, there's another spreadsheet there. We won't present examples of those spreadsheets in this series of presentations, but they're there if you want to have a look at them. Okay, that was number 6. We'll move on to number 7, impact of the response strategy on recovery. So the next section looks again at the herd, goes back to the whole herd, and considers the impact of reducing different components of the herd on the rate of recovery. So we're going to look a little bit further out. Thank you.